How often do you get stepped out? So normally, when traders trade, especially retailers, um, either the stops are too tight or they follow certain rules such as a 2-to-1 reward to risk ratio. And it also all depends on the system and strategy that you use that creates sometimes the stop losses, being stepped out, getting too early, or getting stepped out too early. So the question is, how can you get stepped out, or how can you put in a stop loss without getting stepped out all the time? Okay, so I'm going to go through with you a process. Actually, it's a very simple technique that I basically learned. And when I got to the trading floor, and I finally realized and I finally understand exactly how price operates in a professional institutional type of trading, it actually made a very big difference. Okay, so I will utilize, well, this technique actually works. It doesn't matter what you trade, whether if you trade stocks, forex, futures, or anything, basically, with the exception, of course, with options, because options plays a different ball game. Okay, so I'll show you different techniques. Basically, I'll show you the technique, then I will show you using the technique in an S&P, whether you're trading the VIX, you're trading the dollar index, oil, or currencies. But I will utilize this chart anyway as a form of as an example. Okay, and I will also show you live examples, and perhaps if there's a potential trade, then I will put in a live trade and utilizing the technique that you'll be using. All right. Okay, so let's move on. So our agenda today is simply to have guaranteed stops. That is mainly the topic for today. And if you have any questions, please feel free to type it in or just state it in your unmute yourself and just say it out loud. Okay. So if you want to be successful basically in trading, this is basically my philosophy, my motto. I believe there's 3 different types of conditioning. You have the mental conditioning, body conditioning, and technical conditioning. Mental conditioning plays around 90% of the whole trading game. Body conditioning is around 5%, and technical conditioning is about also 5%. But today's topic or your free lesson for today will be based on technical conditioning. So I love giving out from time to time free piece of information for traders to give you guys a form of value that could add it into your trading. But if you want more, please feel free to get in contact with us, learn from us. We have a different style of trading. I utilize the whole 3 types of conditioning. I believe trading psychology is very important, in my own opinion, that is in sync with your body conditioning. It's a mind-body continuum. And technical, to be honest with you, technical analysis is actually very easy. What makes it challenging is the 6 inches between our ears. Okay, but today we're going to go through. Okay, so if you want to go, just going to reiterate a little bit more. Mental conditioning is mainly the process of how to control your emotions, your mind, your mindset, being mindful, being aware, controlling one's ego. So a few weeks ago, we did a workshop about how to control your emotions. You can go through our website, and on the blog, it actually got recorded, so you can watch that as well. There's definitely lots of techniques, strategies in regards to controlling your own fear, your own ego. If you're not meditating, I highly recommend to do that. In my opinion, I believe it's good to be on your own as well, like going camping by yourself, for example. And a lot of meditation is an important element. Body conditioning is mainly, do you sleep? Do you get enough ample rest in order for you to perform the next day when you're trading? Do you hydrate yourself? Do you eat right? And do you exercise and stay fit? Because everything you see fit. People always think that trading is easy just by having a good system. No, it's not. Whoever's selling you a system that's saying that it's easy, stay away from those. Okay, so those are your warning bells that when you are buying systems or getting into or learning into something and they're telling you that it's easy for you to make money overnight or make 10%, 100%, stay away from those, because trading is not easy, especially at the very beginning. It becomes easier in time, though, in due course, of course. That's what trading is. Okay, so let me see actually. Yeah. So next one is mainly your technical conditioning. There's, of course, different ways to improve your technical skills. Technical analysis, of course, is one of them. Mind you, if you trade on the trading floor, people don't use technical analysis, to be honest. They don't look at charts. They only look at charts afterwards, but when you're on the trading floor, you're trading simply with another person in front of you. But nevertheless, since we are retail traders, I call myself as a professional observer, though. I don't consider myself as a retail trader because I observe the markets, and as much as possible is to buy at a wholesale price point. I can't get in at manufacturing price. Which I will explain to you that because market makers are the ones who can buy and sell at manufacturing price. What my goal is to buy it or sell it at wholesale price point with the lowest risk with the highest probability of winning. And one of the major secrets in terms of trading is actually the management component. So especially the trade management that is in conjunction with the risk management and money management. You can have the most perfect system, but if you don't manage your trades properly, you'll still end up losing. Alrighty. Here are key things that I want you to fully understand, and you need to be very objective. When I'm teaching, I love to be objective. Subjectivity is when you're using your own perception. I don't use my own perception. I don't care about your perception. And the reason being is the market doesn't care about our perception, which means it doesn't care what we think. So if you want to make money in the marketplace, then you need to be objective. And the three major price points that you need to focus on is the high price, the low price, and the close price. And the reason being is because they are your institutional price points. What does that mean? Well, let me go through it with you. I'll take the S&P, for example. Anything that's in between, they are retail price points. Anything that's higher or lower, and also the closing price, they are institutional price points. So who dictates the opening? Simply the amateur, right through the open outcry. It is simply an average price that has been calculated based on trades that didn't push through from the day before, especially when it comes to the equity markets. When you're trading currencies, on the other hand, like Forex or futures, is a 24-hour, almost 7 days a week. So whatever close is also going to be the open price. But when you're trading stocks, the opening, and if you're saying even dealing with stocks like Apple, for example, and this is why there's gaps. So anything that is the opening price, they are all basically amateur price points. And then for the high and the low, it cannot be you, it cannot be me. They're always going to be institutional price points. Okay, so those are the major things that you need to be aware and need to be mindful of. Alrighty, so like today, for example, and here's just a good analogy. The last high of the S&P 500, if you go look through here, so you have the opening price, the high price, low price, and close price. So notice that when I'm actually trading, I seldom use indicators. Remember that indicators are mathematical equations or calculations based on price. Hence, that's why all indicators are lagging. Of course, we have leading indicators. Leading indicators are things that are your macro fundamental analysis that will dictate which one's leading, which one's lagging. There's also the different types of lagging and leading, but nevertheless, all indicators are lagging indicators based on calculated price. So that being said, good traders, professional traders, trade based on price. They know price very well, and the reason being is they follow price. And hence, this, for example, the high price for today is 2,794.5. What does that mean? It means that it did break the last previous high right here of 2,790.4. So that means that someone was willing to place a bid or place the price above 2,090.4. For example, a property that's related to real estate. If you're going to buy property here on the Palo Alto, Mountain View, Cupertino area, and say the last high price was at $2.7 million based on a 4-bedroom, 3-bathroom, 2,000 square feet house, and the last price that it went for was at $2.790 million. Someone was willing to go beyond 2.790. Someone placed a bid above it at $2.794.5 million. So that automatically means that the value of the property within that area is worth more than the last high. So whoever placed a bid that's higher compared to that is expecting, anticipating, forecasting, mainly if you're a statistician and you have a lot of data, meaning that within your neighborhood, the location, maybe perhaps there's more buildings that are going to be built, there's going to be a new supermarket, good schools, and part of the location of the property is that the anticipation of it, that the price will go further beyond $2.790 million, and it could be worth 2.808, a 2.801, and all the way to the high price right there of $2.876 million. So that's what it means. If someone was willing to go beyond a certain price, then they're saying that the valuation or what it's worth of that asset class could be worth more somewhere sometime in the future. However, the last price over here too, you need to see it as 2.801, 2.790, 2.794. Then you have a zone, which is what we call an area of supply. It's also expensive. If that institution is willing to bid above it, then either number one of the manipulation is that they are selling at this point, perhaps they bought it back from what they bought over here from around 2.7, and now they made money, and maybe perhaps they sold it to retailers, someone who is now projecting that the price can go beyond 2.801 and potentially could fail from their own forwards as well, because you also have in an area of supply. Based on economics, never ever buy at supply, never sell it at demand either. That's against the law of supply and demand. Okay, any questions so far what I'm basically explaining to you? Why this is important in terms of high price, low price, and closing price. Any questions? Rizwan, how you doing? Welcome. Balaji, any questions? Lobster, do you have any questions? Rizwan and Eric, do you have any questions? Just type it in your chat box for me, please.
I'm good.
Oh, hi, Balaji. No, none, nothing. Okay. I did. How about you, Eric? Do you have any questions?
No.
Okay, awesome. All right, I'll move on from basically from there. So closing price, why it's there? Institutional price funds is because they're the one who's going to dictate the closing price. It can't be you, it can't be me. Okay, so hence that's why there is always a closing time. Like equities finish at 4 p.m. Eastern Standard Time. Forex close and futures close at 5 o'clock in the afternoon Eastern Standard Time. Okay, so they are very important price points. In between, there are retailers pushing the price, okay, to the upside or to the downside that will vibrate in and out. So now if I go through even to as low as 1 minute, so you'll see that for the last 1, 2, 3, 4, 5, 6 minutes, bam, it basically tanked from 2794 over to 2779. So that means something. So if they push the price in the very last minute, the odds and probability that the price will continue to drop tomorrow is more than likely to happen. Okay, so they know something that we don't know, especially after trading hours. Sometimes news will pop in on the last few minutes or even after trading hours, especially when it comes to quarterly, right? Quarterly reports. So you can see there, right? There's a lot of noise on a smaller time frame, but if you're maximizing that, it's even to 1 hour. That's what basically created, and hence on the daily time frame, that big drop in the last few minutes. At one point, the price was there and then came back down below the opening price. That created some form of uncertainty. They don't know buyers and sellers are currently equal. They don't know whether they should push the price further up or push the price further down. But because you have a new higher high in the past 3 days, when there's a lot of momentum, a lot of force of buyers that push the price to the upside, it is very common that the price will neutralize itself, stabilize, correct itself to the downside to create more demand, and then we'll push it up to the upside once again, which then now, where we're going to go to the next topic, is what it creates the energy flow of price. When there's too much demand, not enough supply, the price will automatically go up. When you have a series of higher highs, meaning that if the high of the day is, say, $1, and then the previous candle all of a sudden is $1.50, someone was willing to bid above $1, 50 cents more. And then the low price is, say, for argument's sake, 80 cents. And then the low price of the next bar is 90 cents. Buyers are willing to bid above $1. Of course, the seller has full control. In here, though, sellers are not willing to sell below 80 cents. So if you know that your value of your property is worth more than anything, will you really sell below profit margin? You don't. Okay, you cannot. I mean, you're not going to be smart if you'll be selling at 70 cents, right? Or your property at $700,000 if you know your property is worth more than $2 million, for example. Unless if you're really desperate, then if someone places a bid at 900,000, the last price at 800,000, but there's no supply out there. There's only one or two supply, but at the same time, do you have more buyers than anything? And the seller will say, well, you want it? I can give it to you for $900,000. And then the person who will be the quickest will take it. And then all of a sudden, demand will come into place and will create above the 1.5 million and so forth. And then maybe it'll close at 1.2. So when that happens, the trend, the probability of price continuing to go to the upside is highly probable. Same thing holds true to the downside. Here, the buyer is in control. When there's no demand with too much supply and you are desperate, the last price, say here, is $1, and all of a sudden there's no buyers coming to play, but you have too many sellers. Buyers will say, well, you want it? I can buy it from you for 80 cents and I will buy every single lot of it. If you're desperate and you're smart, then you will do it. Likewise, for the high price, no one's willing to bid above it because it's too expensive, because they know that it's not worth more than it should deserve, right? And hence, that's why the probability that the price will come back down is highly probable. One thing they also need to know is that when you have a series of higher highs followed by a lower high, this is a very important element. When it creates a peak or a curve, the odds and probability that a new trend is going to start is highly probable. Either a correction on a bigger scale or a change of trend of the bigger scale that will revert from an uptrend to a downtrend. Likewise, when you're seeing a bunch of lower lows, then all of a sudden you have a higher low, this is a starting point of where price is going to reverse, either a correction to the upside from a downtrend or a change of trend from a downtrend to an uptrend. Okay, very important. All right, so Lobster wrote the question: the price showing is for the actual price of the 500 stocks of the S&P, or is it the speculative price of what a trader wants to pay for those stocks, like buying an in or out for the money option trade, then going to a new high is the actual price someone is willing to pay, or is it the high of the underlying stock? So, Lobster, very good question. It is the actual price of the S&P 500 stock. Remember that the S&P 500 is a bunch of the top 500 companies out there, right? And then that has been pre-calculated, some form of calculation in terms of what the S&P price is going to be. Okay, so and then that's why options is so different, because like you have in the money, out of the money, or at the money. Those are like your almost like a pre-calculated sort of price premiums, right? And it plays a different role when to actual real price, whether it will be an index, a stock price, a currency price, or a futures price. Hope that makes sense there, Lobster. Okay. Alrighty, moving forward from there. Once you understand this, this is an objective definition of an uptrend, no more, no less. Okay. All right. That actually also played. It's pretty much like a series of what I also taught last week in terms of trend breakouts. Trend breakouts are very powerful, and they're very consistent in terms of trading results, especially if you get into the right time. Okay, and it doesn't matter what time frame that you do trade. In terms of trend breakouts, they actually appear as like for day trading, momentum trading, scalping, and swing trading, position trading, longer term. So from a shorter term all the way to a longer term, this type of technique, it actually works and it doesn't fail you at all. All right, let me move forward from there. I'll do that because these are my notes. Okay, just 1 second. Go. All right, I think the euro from here, I'll start from scratch, so you'll see why. Okay. Here we go. I will identify basically the low price points, or I call them your major low points, and then you have minor low points. So these are your major low points based on institutional price points. So I'll give you a good example in terms of what we discussed earlier. I want you to look into this. The low price of this is 1.15094. See, you have open price, high, low, close. Low, 1.15097. This low is at 1.15075, which is lower by 2 pips. 10509, 10507. So it's lower by 2 pips. So based on the definition of a downtrend and an uptrend, this is still in a downtrend. Why? Because you have a lower low preceded by, here, this is your high. High, you have a lower high, you have a lower low. So this whole area is a downtrend. Okay, so that's a downtrend. And then next thing you know, you have this low of 1.15267. 15267. Which is very clear that it is higher compared to the last major low. So automatically, all of a sudden, from a lower low to a higher low. But you're saying that, okay, but what's the definition of an uptrend? Well, an uptrend is a series of higher highs and higher lows. You do not have a higher high, you only have a higher low. So the question is, where is the last high before this? The last high was here. So mind you, disclosure and caveat that everything, when things are being explained in the past, everything looks good. In hindsight, everything looks good. That's why I'm not a big believer in teaching over weekends or when the markets are closed, is because of this aspect. Markets are very dynamic. Markets will always move. And this is also why I utilize and I use foreign currencies or foreign exchange as a vehicle for teaching, is because of what it can do as a form of not just practice, as a form of explanation of theory that can be explained in real time. And it can be proven very, very quickly, depending on the time frame that's going to be used. But in this particular case, if you're dealing on a daily time frame, it of course takes time in order for you to see the result of part of manifestation. Sometimes what students have a lot of challenges when it comes to being a student is that they cannot see or have the visual component of what's going to happen. And the reason being is because they're used to receiving confirmations. And the reason being they do that is because they create a bad habit by using indicators. So once you get rid of the indicators, all of a sudden they're blinded and they don't know what to do and they become fearful. When you have an indicator, you have what we call manufacturing price, wholesale price, and retail price. By the time you're using some form of an indicator, like say we use an indicator as part of our methodology, which is called method number 3, where you're using any type of moving averages, that is going to be some form of a retail price, whether we like it or not. Why? Because a moving average, if you know math very well, moving average is simply the average between two price points, mainly from the low and the high. That's basically it, right? So that being said, systems have hierarchy, and moving averages is the last of the hierarchy. Then, of course, you have oscillators. Oscillators are mainly indicators like your momentum indicators, RSI indicators, stochastic CCIs. And then you have MACD indicators, right? So those are all oscillators. They are all cousins that mainly dictate overbought and oversold conditions. And yes, we also do have a methodology, we call method number 2, that utilizes an oscillator. So our indicators are mainly last on the line. They're just an indicator to add in to the probability of winning. So the way how I trade and the way how I teach the trade is all about measurement of probabilities. Once you have a high probability of winning, then you can execute, then you can also define your position size. Because risk management is very important. It's, in my opinion, is more important than finding entry points, to be honest. Because we can have heads or tails as a system. So if heads is telling you to buy and the price is dropping, the question is, what are you going to do with it? Are you going to cut your losses really quickly and go with the sell position? Or are you going to revert back to create numerous strategies? In trading as well, there's not just one solution. There's actually multiple solutions in trading, which I will actually also share with you. I have it there. No. Yeah, I'll open up my account and I'll show it to you guys, basically how strategies can be implemented one after the other. So, but nevertheless, going back through here, if this low is not willing to go below this low, that means something. An institution is willing to purchase higher compared to the last low. The seller basically told the buyer, screw you, because I know for a fact someone also plays a bid below this low, 115.075. So if you and I are all going to bid below 115.075, but the seller says, get lost, I'm not going to sell it to you because there's no more supply left. You want it, you can have it for 115.267. The first person or institution will snatch it because they also know that it's a good price to buy. Boom, they will actually snatch that from a selling point of view. And then this is where, if you're following, just imagine this. This is what it looks like actually in the trading floor. It's like an octagon. It's like an MMA fight. So you have the market maker sitting somewhere here. Then all of a sudden, you have all the buyers and sellers, depending on where they're at. Once the market maker create and dictate the price, someone snatches it, and say, for example, you work for Goldman Sachs. Goldman Sachs snatches at 1.1526. What do you think you're going to do? And they bought a big amount. Then you will get in there too as fast as you can, and hence what creates that. See the amount of force between the body that basically created from the closing price all the way to the opening to the closing price. Stabilize itself before it can continue to the upside. Okay, so that's why when you're in this area, this is where you're getting at wholesale price, where you have the lowest risk with the highest probability of winning. And by the way, if you're here today and you're listening to this, please don't share it to anybody. because this is actually, I paid also a lot of money, and I'm showing you this with this one, and this is also my bread and butter. One of my bread and butter, basically, when it comes to making money, consistently trading the markets. Okay, it might be something, I don't know whether it's new to you or it sounds like, hang on a minute, but why are you buying there? There's no confirmation. You don't need confirmation. Our confirmation is based on price. Okay, and the reason being, now you want to put a guaranteed stop. If you put your stop loss below the last low of an institutional price point, you're not going to get stopped out. And the reason being, you and I are retailers. These are institutional price points right here where buyers are supporting price, mainly institutional price points that are supporting these prices. It will take a lot of force in order for this to break. Do you understand what I'm saying? So if you and I are retailers and we are a small fish to the open sea, what are the odds that we are really going to get stopped out below 115.075? Even if you put your stop at 1.15, it's almost guaranteed you're not going to get stopped out unless news is going to play a big factor of it. Okay, so that is the caveat. However, if the strongest of the lot is when you're in an uptrend, go long. When you're buying, so here's mainly the rules. Buying in an uptrend, and you're putting your stop on the last low in an uptrend, you're not going to get stopped out. Selling in a downtrend, and you're putting your stop on the last high off the trend, guaranteed you're not going to get stopped out. Here, the confirmation is this blue bullish candle right here. So anywhere you're buying from here, you can buy here. So we have a strategy. The strategy is that, because whether I like it or not, we're in a downtrend. Dojis are very powerful and they're actually really good. Test trade, putting test trades, and then when you have a confirmation, you add into the test trade, because now if the target points are mainly going to be utilized above highs or supply levels. Okay, so the rule is that if there's a higher low, then a higher high should follow next, which follows suit. Where was the last high? The last high was here. Then the odds and probability that this high will break is highly probable, which it did right there. So the profitability of a distance of 167 all the way to 237 pips right there. Okay, so that's a lot. That's pretty good, actually. Yeah, in the currency world, that's a good amount of money that you can make basically in a span of about a week. Okay, so here, 1, 2, 3, 4, 5, 6, 7, 8 days. So we know one almost standard lot, that's like a $2,000 of doing nothing, basically, if you're dealing on a daily time frame. Okay, so once again, to put in your stop is mainly to have a guaranteed stop, is putting it on the last low of the trend. Okay. I will use this one to as an example right here. Here's if you trade futures, and I do trade futures as well. These are based on all my notes. If you follow my uh, reports or market updates, it's been here for a while, right? So strong area demand, notice low is higher compared to that. And then notice this low created another one, a confirmed low, another higher low. Notice this one, another confirmed higher low. So a few weeks ago, we also discussed about piercing patterns. When you have a piercing pattern and you followed by a higher low, the odds and probability of you winning is highly, highly probable. So in this particular case, where will you put your stop loss? If it doesn't matter where you're going to be buying at, you're buying over here, you're buying over there, you're buying over here, you're buying over here. If this is your stop loss, put in your stop. In the currency markets, I have a rule of low minus 15. With futures, pretty much it's almost the same, is low minus 10. If you really don't want to get stopped out, I always put minus 15. But you can also low minus the spread, which is also valid. And then mind you, here's the important about risk versus probability, or even reward. Okay. If you're buying here at 27.10 and your stop loss is at say 26.90, there's a deficit of 20 in terms of stock. And your target point is say at 27.80, where you now have a plus of 70. Then when it comes to risk versus reward, you have a 1 to almost 3 risk to reward ratio. Is that phenomenal? Absolutely. The risk becomes zero once you trail your stop to break even. You're only going to do that when price is all the way beyond your entry point. Okay, so 27.20, 27.10 is your entry price. Once you put your stop loss at 27.10, then your risk is now zero. Your reward becomes infinite. By the time it goes above zero, then definitely your risk is definitely zero, and your reward is definitely now infinite. Regardless of what happens, you're going to make money. Okay. Don't rely too much on the risk to reward. Rely more on the probability to risk and probability to reward. And the reason being, price can only go in two different directions, to the upside or to the downside. Does that make sense? It can't go simultaneously up or down, up and down. It will only go to the upside or to the downside. So the question is, which one will go first? To your target point or to your stop loss point? To your target points is simply when the energy flow of price, when you're buying, is to the upside. When you're in an uptrend, you'll definitely make money. And hence, patterns such as bullish flags, right, bearish flags, that's the whole point of those patterns, is because which has hierarchy, your higher lows or your lower highs. But it's up to you to figure it out in your analysis. Like this one, for example, your lower highs have no hierarchy based on a bigger scale of things. They only have hierarchy based on a small grandeur of things in terms of a correction. Okay, so once you can dictate that and you know which one's your major, lows, then you can put your stop on those major lows and you're guaranteed you're not gonna get stopped out. Any questions? Eric, any questions? Balaji, any questions? Joe? Lobster disappeared. I'm going. So, Eric, any questions? Does it make sense? Balaji? No?
No, very interesting. Very good.
All right. Excellent. Yeah, thank you, Balaji, for your feedback. Okay. Balaji, what do you trade by any chance? If you don't mind me asking. Do you trade stocks, Forex futures, or options? Oh, okay, gotcha. Perfect. Right, so that actually also works. So you trade stocks. So I'll just put Amazon for now as an example. See, look, Amazon is in an uptrending market, right? That's why once a demand price hits demand and you have a higher low, you can buy anywhere demand you put on the last low, you won't get stopped out. Okay, so here the question is, can they push all the way now to the last high? If they're not going to do that and the price is dropping tomorrow, you can sell it, put your stop on this high and your target price is 80. The probability that you can make money without you getting stopped out is highly probable. And the reason being, or to create a lower low, so this actually is a good one. So if tomorrow you have a clear cut of a confirmation that this is, no one's willing to go beyond that high, you can short this. Your stop is above 1763. Your target point, if you want to have 100% probability of winning, 1680. That's like a 40, ooh, no, that's a $60 profit right there. Can it go below 1660, even can it go 1640? Absolutely. But when that happens, so you get a good price, a wholesale price point to have that distance of profit margin right there around $40, and your stop is only 20 bucks or even 30 bucks. So you have a more than 1-to-1 reward to risk ratio with a 99.99% probability of winning. Okay, so that is a perfect example of our topic for today. Okay, let's look at oil, for example. Likewise for oil, this is crude oil. If you're trading futures, if you're going to short this one, your stop loss is at above, say, even 76. To gain 72, even 73, even say $1. That is a good high probability you're going to win. Can it go to 71 back down to 70? Absolutely. Easy. Right? So that's another example. With a confirmation that no one's willing to go beyond that by tomorrow. All right, let's look at gold. Same thing with gold. This is the last low. If this low is higher compared to that, easy, the price can go to $1,285 a barrel. Really, of course, they need to beat those price points. Okay. Copper has been battered in a while. If no one's willing to go below this low, and you're seeing that the low is higher compared to that, currently you're in a buying area. Low is very, the risk is very low, and you have a higher low, you put your stop on this low, guaranteed you're not gonna get stopped out. You'll make money 10%. You go to 2.9, even 295. Okay. So indices, even I can go to even say the DAX. See here, you're buying right there, 12,300. Your stop is here. Your stop is right there, 1210. Currently I'm 12.6. That's a 300-point move. The Dow is also the same. So told a couple of private clients, 24,200 is a good buying area. Stop loss at 24. Sorry, below 23. Yeah, 23.99. So even say you put 23.90, can go to 24,800. So there's a 600-point move profit right there. Okay, dollar index, same thing. Right. Currently, we shorted the dollar. Stop loss is above there. Currently, it's still within the criteria. I don't think it's not ready to buy in as yet. So that's on the euro. I'll go one more. I think the other one was a nice one. Was also US dollar. That's too late. So here we can short this one. Here you put a stop right here. It's still in a downtrend. Odds and probability go to 73.75 over 73.50 is highly probable. It's still basically in a downtrend. Okay, so those are a lot of good examples right there. So now just to wrap it up, is that if you put your stop in an uptrend, you put your stop loss on the last low of the trend, guaranteed you won't get stopped out. If you're in a downtrend, you put your stop loss on the last high of the trend, or the impulse of the trend, you're not going to get stopped out. Alrighty, any questions for me? Thank you, Eric, for coming. Eric is gone. Balaji, any questions? Hi, Christopher. I know you came a little bit later. Joe, nothing. Well, if you have any questions, please let me know. Email us at estraders@gmail.com. For July, we have a special. If you want extra learning, we're offering a 30-day, basically, learning experience, okay, basically for free. And then after that, if you want to continue, great. If not, that's okay too. There's nothing, basically don't push people. If just they like what they see, then they continue their education. But if not, then at least they've gained 30 days of free education. All right, guys. Other than that, thank you so much. Balaji, thank you for coming in. Christopher, thank you for coming in. If you have any questions, Christopher, you came a little later. And Joe, thank you for coming in. Take care until next time. Happy trading, guys.